In 2014, Bed Bath & Beyond borrowed $2 billion. Not to open new stores, not to hire more workers, not to build better products or upgrade their technology. They borrowed it to buy their own stock. Over the next decade, the company would spend nearly $12 billion doing this, more than twice what they owed in total debt when they filed for bankruptcy. 30,000 people lost their jobs. The stock went to zero, and 3 executives walked away with over $140 million in compensation. This isn't a story about one badly run company. It's the story of a financial maneuver so widespread that in 2025, American corporations are on track to spend over $1 trillion buying back their own shares, much of it with borrowed money. And for reasons that will become clear, it's creating what some economists are now calling a new class of walking dead companies, zombies that are profitable on paper but fundamentally broke. Let's start with the basic question. Why would a company buy its own stock? The textbook answer goes like this. When a company has extra cash and can't find productive investments, returning money to shareholders makes sense. Buybacks are just another way to give value back, like paying a dividend. Except there's a mechanical difference that changes everything. When a company buys back stock, it removes shares from circulation. Fewer shares means each remaining share represents a bigger slice of the company. So even if the company's actual value stays exactly the same, earnings per share goes up. It's not growth, it's arithmetic. But here's where it gets interesting. Most executive compensation packages are tied to stock price and earnings per share, not revenue, not innovation, not whether the company will exist in 10 years, just the stock price. So if you're a CEO with millions of dollars in stock options and you have a choice between spending money on research that might pay off in 5 years or buying back stock that will boost your compensation this quarter, what do? You buy the stock. And if you don't have the cash sitting around, you borrow it. This is where the math starts to feel absurd. In 2018, American companies bought back a record amount of stock, $900 billion. By the next year, more than half of all buybacks were financed with debt. Not profits, debt. Think about that for a second. You're borrowing money not to invest in your business, but to make your stock look better. You're taking on obligations you'll have to pay back with interest to create the illusion of performance. It's like taking out a loan to buy your own car from yourself at a higher price so you can tell your neighbors you made money. And for a while, it worked beautifully. Here's how the cycle played out. Interest rates after the 2008 financial crisis dropped to near zero. Central banks flooded the market with cheap money to prevent a depression. Suddenly, corporations could borrow billions at rates lower than inflation. So they did. Boeing spent $43 billion on buybacks between 2013 and 2019, more than their total profit during that period. They borrowed heavily to do it, weakening their balance sheet just before the 737 MAX crisis hit. When the pandemic arrived and Boeing needed a bailout, they were sitting on nearly $50 billion in debt. The money that could have gone toward engineering, safety, or cash reserves had been funneled into buybacks. The stock still collapsed, but the executives who timed their stock sales around the buyback announcements did just fine. Bed Bath & Beyond spent $7 billion on buybacks, while their stores grew outdated and their website lost ground to Amazon. When they finally needed cash to compete, there was none left. The debt they'd taken on to prop up the stock became the anchor that drowned them. This is the uncomfortable truth. Buybacks don't just redistribute value. When funded by debt, they transfer risk from executives who benefit today to workers and creditors who pay the price tomorrow. Now, you might be thinking, isn't this illegal? Actually, it was, until 1982. Before that, buying back your own stock was considered market manipulation. The SEC classified it as a scheme to artificially inflate prices. Then the rules changed. A new regulation called Rule 10b-18 created a safe harbor. As long as companies followed certain guidelines, buybacks were fine. The floodgates opened. In the 1980s, buybacks were relatively rare. By the 2000s, they were standard practice. By 2020, they were the dominant use of corporate cash. In 2024, buybacks reached $942 billion. In 2025, they're projected to break $1.3 trillion. For context, American companies are now spending more on buybacks than the GDP of most countries, and an increasing share of it is financed by debt. Here's what makes this particularly strange. When a company pays a dividend, cash leaves the building. Shareholders get money they can spend. The company becomes slightly less valuable because it has less cash. When a company does a buyback with borrowed money, nothing of value is actually distributed. The company takes on debt, buys its own shares, and retires them. Cash goes out, debt comes in, and the only people who benefit are the shareholders who sell. But the company still has to pay interest on that debt, forever, or until they pay it back, which many never do. This is how you end up with zombie companies. A zombie, in financial terms, is a company that can't generate enough profit from its operations to cover even the interest on its debt. They're technically solvent, they're still operating, but they're trapped. Any downturn, any unexpected cost, any spike in interest rates, and they're done. An Associated Press analysis found nearly 7,000 zombie companies worldwide, 2,000 of them in the United States. Their combined debt runs into the trillions, and many of them got there by borrowing to buy back stock. Let's talk about the timing, because there's a feature of buybacks that doesn't get discussed enough. Companies aren't required to disclose buyback activity in real time. They announce a program, but actual purchases can happen quietly over months or years. Multiple studies have found a curious pattern. Executives tend to sell their personal shares shortly after their companies buy back stock. The buyback pushes the price up, the executives sell into that artificial spike. Then the price drifts back down. It's not technically illegal, but it is, to put it mildly, convenient. In the S&P 500, the correlation between executive stock option schedules and buyback announcements is hard to ignore. Buyback programs are often timed to corporate calendars when equity compensation vests. One analysis found that in many cases, over a third of total CEO pay now comes indirectly from the boost provided by buybacks. Think about the incentive structure that creates. You're a CEO. Your compensation is tied to the stock price. You can invest in long-term growth, which is risky and might not pay off during your tenure. Or you can buy back stock, goose the numbers, exercise your options, and let the next guy deal with the debt. What would you do? What are you financially incentivized to do? Here's where the story gets darker. Because buybacks don't just hurt companies that go bankrupt, they warp the entire economy. Over the last 15 years, 94% of corporate profits have gone to shareholders in the form of buybacks and dividends. 94%. That's money that didn't go to worker wages, or research and development, or building new capacity. It went to inflating stock prices for people who already own stock. And because stock ownership in America is heavily concentrated, most of those gains went to the top 10% of households. As of 2023, the wealthiest 10% of Americans held 93% of all stocks, the highest level ever recorded. So when companies borrow money to buy back stock, they're effectively borrowing from the future to enrich people who are already rich at the expense of investment that might create jobs or raise productivity. It's a machine for turning corporate resources into executive bonuses and shareholder payouts while leaving the company itself weaker. Now, defenders of buybacks will make a few arguments. They'll say buybacks are just returning capital to shareholders who can invest it more efficiently elsewhere.
But when half of buybacks are debt-financed, no capital is being returned. Debt is being created. They'll say companies only do buybacks when they don't have better opportunities. But Boeing, Bed Bath & Beyond, and hundreds of other firms that bought back stock had glaring needs. Upgraded outdated stores, fixing product defects, investing in technology. They chose buybacks instead. They'll say it's the shareholders' money and they can do what they want with it. But when these companies go bankrupt, it's workers who lose jobs and taxpayers who sometimes fund bailouts. The executives and shareholders who benefited are long gone. And they'll say that earnings per share growth from buybacks is real growth. Which brings us back to the fundamental problem. It's not. Let me give you a scenario. Imagine you own a pizza shop. You make 10 pizzas a day and sell them each for $10. Your profit is $100. Now imagine you borrow $50,000, not to buy better ovens or hire more cooks, but to buy back half of your own business from a partner and retire their stake. You still make 10 pizzas. You still make $100. But now you claim your profit per ownership share has doubled because there's only one owner left. Did your business get better? No. Did you create value? No. Are you now saddled with debt and interest payments that might sink you when sales dip? Yes, this is what debt-financed buybacks do at scale. The irony is that none of this is a secret. Credit rating agencies have been warning about this for years. The SEC has published research questioning whether buybacks align with long-term value. Economists across the political spectrum have raised concerns. But the practice keeps accelerating. Because the incentives haven't changed. As long as executive pay is tied to short-term stock metrics, and as long as buybacks are legal and easy, the cycle continues. And every time interest rates drop, it gets worse. Cheap money makes borrowing irresistible. And when rates eventually rise, the zombies multiply. Right now, in 2026, hundreds of billions of dollars in corporate debt is coming due. Much of it taken on during the low-rate years to fund buybacks. Some of these companies will refinance, some will sell assets, some will file for bankruptcy. And when they do, the executives who approved the buybacks will have already cashed out. So where does this end? One possibility is regulation. Some lawmakers have proposed restricting buybacks or taxing them more heavily. In 2022, Congress passed a 1% excise tax on buybacks. It barely made a dent. Another possibility is a market correction. If investors start questioning whether buyback-driven earnings growth is real, the whole edifice could unravel quickly. But so far, Wall Street keeps buying. A third possibility is that we simply accept this as the new normal. Companies borrow, buy back stock, enrich executives, pile up debt, and occasionally collapse. Rinse and repeat. But there's a cost to that. When corporations prioritize financial engineering over actual engineering, when short-term stock pumps replace long-term investment, when borrowed money goes to shareholders instead of workers or innovation, the economy doesn't grow. It extracts. Here's the question nobody wants to ask. If a company borrows billions of dollars and uses that money to buy its own stock instead of investing in its future, and executives get rich while the company slowly dies, who actually benefited? Not the workers who lost their jobs, not the taxpayers who funded the bailouts, not even most shareholders whose gains evaporate when the company collapses. Just the people who sold at the top. And the system that allows this isn't broken. It's working exactly as designed. The uncomfortable truth is that modern corporate finance has created a mechanism to harvest value from companies and leave behind shells. Buybacks financed by debt are the tool. Executive compensation is the motive, and lax regulation is the enabler. Bed Bath & Beyond spent $12 billion to make its stock look good. Boeing spent $43 billion. Across the economy, trillions have been funneled into this machine, and we call it shareholder value. So the next time you hear that a major corporation just announced a massive buyback program, ask yourself, are they funding it with profits or debt? Are they doing it because they have no better use for the money, or because executives have options vesting? And what happens 5 years from now when the debt comes due and the cash is gone? Because somewhere, right now, another company is borrowing billions to buy its own stock, and the executives are about to get very, very rich.